So first of all, I have to do the quick disclaimer here that me, the presenter of this webinar, is not an expert in the area of asset or shale purchases or sales. It's for general information purposes only. The listener reader is advised that prior to entering into an agreement of any kind of purchase or sale, to consult with an expert in the area, for example, a lawyer or an accountant. I have to put that in so I can cover myself just in case I say something wrong. So the first thing I want to talk about is a non-disclosure agreement. The non-disclosure agreement in general, the best one is Form 560. This is the RIA Form 560. It does indicate what information can be shared with shared and what information will be shared and who it may be shared with. And non-disclosure agreement between a seller and buyer may state that an income statement can only be shared with the buyer's accountant, as an example. I do have to warn people about NDAs. When you have signed a non-disclosure agreement, the courts look at non-disclosure agreements very, very serious. When you have a non-disclosure agreement or your buyer has a non-disclosure agreement, it's a serious document. The information should not be shared with anyone other than the people named on that agreement. Be careful, just don't go blabbing around. Sometimes a non-disclosure agreement is between you as the real estate salesperson calls the listing brokerage and say, for example, I want to have an income statement for the business. And the listing brokerage says, no problem, we need a non-disclosure agreement, and sends you one. And that non-disclosure agreement is between the brokerages. When that happens, you then need to have a non-disclosure agreement between the brokerage and the buyer or seller, whatever the case may be. And so do be careful about non-disclosure agreements. We do have, just as a side note, we do have a non-disclosure agreement in our Google Drive that is not Form 560. The non-disclosure agreement in our Google Drive covers everybody all at once. It covers both brokerages, buyers, and sellers all at once. But that's usually used for, kind of the more complicated kind of deal. And so it is there if you need it in Google Drive, but normally Form 560 will cover it for you. And it's used all the time. But do be careful with them. When you have signed a non-disclosure agreement, they are serious agreements. Be careful who you share information with, please. So what is an asset sale? An asset sale is the sale of a business, which may include a building, goodwill, equipment, chattels, stock, etc. And as an example, a resale home is an asset sale. Now, I know we're talking about commercial here, but a resale home, the bricks and mortars of the business, is an asset sale. And so pretty much most of you would be familiar with that. And an asset sale for a business is no different, really. It's including the actual physical goods. It's not quite physical, but it is still can be an asset sale. Equipment, chattels, stock, etc. can all be part of an asset sale. The advantages to an asset sale for a buyer. Any debt in the company stays with the seller. So often businesses could be sold and the buyer only wants to buy the assets because they don't want to think about the debt that's included. All the buyer is purchasing are assets, so it's safer for the buyer. Number two, the buyer may be able to increase the asset values for the purposes of depreciation. That's called a step up. Now, we've talked about depreciation quite a bit in the last two sessions. And just as a reminder, for tax purposes, owners of companies can depreciate equipment. They can depreciate buildings. You cannot depreciate land, of course, land appreciates. And so let's just say that they've depreciated a piece of equipment down to $100. Well, the fair market value of that equipment could be $600. Buyer may be able to increase the asset values for the purposes of depreciation. It's called a step up. Buyer can specify which assets, or if they want to buy liabilities, that it is buying. So does the sale price include accounts payables or accounts receivables? And last but not least, less due diligence. And so I've got in here savings in lawyers' fees, but there's also savings in time and effort and money, because generally you don't have to do as much due diligence when you're buying an asset sale. Any questions so far? Okay. Buyer disadvantages for an asset sale. Contracts, especially with customers and suppliers, may need to be negotiated. Because you're buying the assets, you may not be buying the name of the company. And even if you're buying the name of the company name may not carry forward into separate contracts with suppliers and customers. So you may have to do some renegotiations. The tax cost, and this is the big one, the tax cost to the seller is typically higher with an asset sale. So the seller may insist on receiving a higher purchase price. And I've got a little asterisk there, and we're going to talk about why that is in just another slide. Employment agreements with key employees may need to be renegotiated. Now, that is in general, that employment agreements are difficult to hand over to a new owner. A lot of the times in an asset sale, the seller will lease and give notice to all the employees that they are being let go. And then the new buyer has to pick them up again and have new employee contracts. That does not necessarily apply to a union situation, but I think for us, most likely the chances that you're buying a business that's unionized are probably pretty low. And so I did not get into that. And actually it's beyond my scope on how to go about doing that. That would be an employment arrangement that would require a lawyer to take care of. The seller still needs to liquidate any assets not purchased, pay any liabilities that not been assumed, and take care of any of the leases that need to be terminated. And so sellers don't want to necessarily do that. That's a lot of work for a seller. So it becomes a buyer disadvantage. And if the business has land or property that the buyer is purchasing, land transfer tax should be payable. Could, maybe be payable. There's all sorts of differences when it comes to land transfer tax in a business that has land or property. And what's involved in that, once again, is beyond the scope of this presentation here, but it should definitely be questioned with a lawyer or an accountant. There's different land transfer taxes that can be applied when it's a business that also owns a building. So be careful about land transfer tax. Usually the buyer will have to pay something, okay, when a building or a land or property is involved in an asset sale. Any questions? Okay. So asset purchases, as I mentioned before, the tax cost to the seller is typically higher. So the seller may insist on receiving a higher purchase price. Why? First of all, the seller will have to pay capital gains on the profit made. Pretty much the same, whether it's an asset purchase or a share purchase. But as part of negotiations, the value of the depreciated assets may come into play and brought up to fair market value in an asset purchase. The seller may have to pay recapture tax. Recapture tax is it equals the asset negotiated value minus the asset depreciated value. So once again, you have a piece of equipment. The seller has depreciated that value to $100. As part of the negotiations, the buyer says, yeah, but I want that value to be $700. So what happens then? What happens then is that the seller has to pay recapture tax on the difference between the negotiated price and the asset depreciated value. This can come into huge dollars. And so often a seller says, okay, fine, if you're going to do that, then I want more money because I have to pay my recapture tax on the negotiated value of the asset. I know that's maybe recapture tax might be the first time people have run into recapture tax. Does anybody have any questions about this? Forms. For an asset sale, you use the commercial agreement of purchase and sale, Form 500. A commercial working with a realtor is Form 811. All right. Don't forget that the residential one is 810. A buyer representation agreement is the same. Whether you're working for commercial or you're working for residential, the buyer representation agreement is the same. The confirmation of cooperation, Form 320, is the same. Most would have a Schedule C for chattels. I have seen it that it's tried to squeeze into the chattel section on Form 500, and it's really hard to do if there's a lot of equipment. As a reminder to you for chattels, make sure that there's a detailed list, you guys. When you're doing a commercial deal, I love it when it says in chattels, all tables and chairs for a restaurant. Well, what is the definition of all? Anyways, all table and chairs. No, it's 45 chairs and 15 tables. You know, you actually have to take the time and count your chattels, okay? Don't take a shortcut when it comes to chattels. So there's a question in the chat, Form 801 for purchase sale of a business or commercial deal. In general, the answer to that, Ed, is in general, Form 801 is a requirement for all brokerages, in generally speaking. Now, having said that, most commercial brokerages do not use Form 801. And so read brokerage remarks very carefully to see if they're asking for Form 801. But if it's a listing with a CBRE or a listing with something like a Cushman Wakefield, something like that, they're not using Form 801. And so if it's a Remax, definitely, you know, or Royal LePage or something, they're probably going to ask for a Form 801. Okay.
Well, Form 801 is not really a requirement for any deal. It's just you have to keep all copies of all offers if you're in a multiple offer situation. Right.
That's correct. Absolutely, 100%. I agree with you 100%. But you know, most brokerages do have just a general rule that Form 801 is just included. That's the end of the story, and we're the same.
Okay.
For FINTRAC, so for FINTRAC, if it's an asset sale, it could be either the individual or the corporate identity form. So do be careful on which one. We were caught the other day, sale of a business. It was definitely a numbered company, and the agent, our agent, did an individual FINTRAC form. So do be aware that there's the two different forms, individual or corporation entity forms. And as a reminder to everybody, if the buyer or seller is a corporation and you're representing them, you must see the articles of incorporation confirming that the signer has the authority to bind the corporation. All right. You've got to be sure, you must be sure that that has the authority to bind the corporation. And we just ran into this a couple of weeks ago. If Aaron's still on, then he'll remember this, that we had one shareholder saying that he could sign for the corporation when there were 4 other shareholders. And so the answer was no. And luckily our agent caught that and took care of that. So do be careful. Make sure you see the articles of incorporation. It's really important. If there's one shareholder on the articles of incorporation, you're fine to go. It's the only one. But if there's more than one shareholder in the corporation, what happens then? Does everybody have to sign off? And often that is the case. 3 shareholders, all 3 shareholders have to sign on all the documents. However, sometimes in the minutes of the articles of incorporation in your minute book, the shareholders will direct one shareholder to be able to bind the corporation. If a shareholder is saying that to you, that they can bind the corporation, you need a copy of the minutes of the corporation that proves that fact. Does anybody have any questions about any of this? Once again, getting off easy here. Share purchases. A share purchase is when the buyer purchases usually all of the shares in a corporation. In effect, the buyer is purchasing the whole corporation, a numbered company, John Inc. Limited, whatever it is, you're buying the whole. I would advise you, and I put in usually all, because if you're going to get into a deal where you're buying 50% of the shares of a corporation, you may as well stop right now. It's a whole different story. But in both cases, I want to point out that a share sale is not regulated by RICO. It is regulated by the Security and Exchange Commission. So there's all sorts of rules and regulations in regards to share purchases that we have no idea about. And certainly, as the presenter of this, I put in the disclaimer, I have no idea how the Security and Exchange Commission works. So you do have to be very careful about it. And I can highly recommend that if somebody comes to you and says, I want to buy 50% of the shares of a corporation, then you're going to do a letter of intent. And we're going to talk about that in just a few minutes anyways. However, because you are a real estate salesperson, broker, realtor, whatever you're calling yourselves these days, fairness, honesty, and integrity still matter as per the RICO Code of Ethics. You are still bound by the RICO Code of Ethics. You still need to know what you are doing, and you should know that a share purchase is not regulated by RICO, and it's regulated by the Security and Exchange Commission. Does it mean that you can go ahead and do a share purchase? And the answer is yes. You can act on behalf of a buyer or seller. And I would certainly recommend that anything less than a 100% share purchase, that you take a deep breath and whether you want to get involved in this or not. And I would probably say no, unless you have a letter of intent. We are not experts in the securities law. You can complete a Form 500. Form 500 is the equivalent of Form 100 in the residential world, and pretty general form. And you can include in Schedule is a 100% share purchase. Okay, you have to put that into Schedule A if it's a share purchase and you're only buying shares. Okay. Alternatively, you can complete a letter of intent. A letter of intent outlines all of the parameters of the sale, but then the lawyers for the sellers and the buyers take over. And I am really trying to push people that, are you doing a 100% share purchase or less? Do a letter of intent, you guys. It's so much better. And then let the lawyers take over and deal with the shares and how they're exchanged and all that kind of good stuff and complete the sale for you. And if you have the signed representation agreements and a confirmation of cooperation and representation, you're away to the races to protect yourself for your commission. When you have a letter of intent and you send it to, for example, a buyer's lawyer or a seller's lawyer, include your confirmation of cooperation and representation, include your signed representation agreements, include your working with a realtor, and fire it all off to a lawyer. And you're going to save yourself all sorts of problems and all sorts of work. I know that there were a few agents in Thornhill that did a deal for a, if I remember right, it was a daycare. And they had a letter of intent, and thank goodness they had a letter of intent, because it took almost 1.5 years to close the deal. Can you imagine if you're trying to do that yourself? That was the lawyers closing the deal on a letter of intent. You try to get in the middle of that in a Form 500 and waivers and amendments and notices of fulfillment and due diligence and all that wonderful stuff. I'm trying to tell you folks, do a letter of intent. And we'll go over a letter of intent in another few slides. Shares, advantages for buyers. Often the price will be lower than an asset sale because a buyer cannot automatically step up. I should have put in automatically step up the value of the assets. It becomes negotiable, the value of the assets. We talked about a step up in an asset sale. A buyer can do it automatically. In a share sale, it cannot be done automatically. It becomes part of negotiations. A real advantage is that brand recognition stays the same. No or little renegotiation of contracts or suppliers. Just everything, the contracts, everything stays the same because it's the same company. And I've got in bolded here, you may avoid land transfer tax on land and structures. And that once again is beyond the scope of this webinar. You must refer to an accountant or a lawyer. And of course, in any deal you do for any business, you should have a lawyer's review for sellers and buyers to make sure that everything is staying on the right side of the law. But in a share sale, you need lawyers' reviews. Why? Because it is not regulated by RICO, it is regulated by the Security and Exchange Act. So always lawyers' reviews, please. Share of sale buyer disadvantages. You take on the liabilities of the corporation. Once again, you're taking on the depreciated value of the equipment, chattels, or you're negotiating the value. You must complete a detailed due diligence. And that's generally because you don't want to take on any liabilities unless you know what those liabilities are. And sometimes we read this in the Globe and Mail or the Financial Post that such and such a company is right now, actually as a real example, is trying to buy Shaw Media, I think it is. And part of the cost of buying is they're taking over all the liabilities that they have. So you can negotiate those liabilities for sure. But remember, if they're not caught, if those liabilities are not caught, all liabilities move on with the sale, including environmental liabilities. Be careful. And often you can write, and there's lots of clauses for this, and I've seen lawyers put these together in amendments, that a seller guarantee. The seller guarantees is that if there's any liabilities, that the seller will take care of them. Well, what happens if the seller has none or very little personal assets to take care of those? What happens if the seller is a really smart guy and he's got all his stuff in other corporations? Well, then you can't go after him. So you do have to be careful about seller guarantees. When it comes to liabilities of the corporation and existing debt in the corporation, if it's not being negotiated with the seller, then often, and I have seen this many times, that there is a holdback. There is a holdback of the sale price that the buyer's lawyer holds back, whatever the kind of value. Let's say $10,000, $20,000, $30,000, $40,000, $50,000 for 6 months after the completion date, so that any creditors that are coming to the new buyer that says, hey, the seller didn't pay his bills, that the buyer has the holdback funds to pay for those. It's another way to help with the liabilities of a corporation that were not found in the due diligence process. Any questions about that? Okay. Shares sales and asset sales. Share sales and asset sales. In both cases, it's normal for both parties to declare value of chattels, goodwill, equipment, building, and land. Land doesn't depreciate, but everything else does, and was resulting in what could be difficult negotiations. There's some great clauses that we have in office clauses in web forms. Clause C516. Clause C516 is the buyer asking for the seller documents. Included in the seller documents is, we want to see your declaration of the depreciated value of your business. Like, what have you depreciated? What has it gone to? It's asking for your letters of, your notices of intent. Your 516 asks for the income statement. It asks for the value of the chattels. It asks for the value of goodwill. It asks for all that stuff. And then the buyer's lawyer can look at that and determine what's the best way to move forward. C519. C519 is an excellent clause as well for seller representations and warranties. Now, C519 has 19 parts to it, and not all 19 parts apply to all the different sales out there. And so you have to go through all 19 parts to pick the ones that apply to your agreement of purchase and sale to make your buyer's needs. For example, in C519, there's an LCBO clause in C519. Well, if you're buying a place that doesn't have an LCBO, well, then you need to remove that as an example, okay? Also in office clauses is C084. C084 is a clause that Isabel, the broker of record, and myself made up. C084 is an excellent due diligence clause for the buyer, okay? And you can add stuff and take stuff out of C084 as you need to, but it definitely covers most things, including environmental, for a business sale. So those three clauses, C516, 519, and C084, covers an awful lot. If you also then include a lawyer's clause, maybe a financing clause, you're good to go. Though I have to tell you, C084 has financing in it as well. But certainly, you know, those 3 or 4 clauses, you don't have to get all carried away with a million clauses and conditions in an offer for a business, because these 3 or 4 clauses cover just about everything under the sun. Any questions? Letting me be easy. So a letter of intent. There are just a few samples in your Google Drive, okay? But you do want to always include the following: the names, buyers and sellers, address of the property, shares, whatever, conditions, financing and due diligence, or previous conditions, the deposit amount, when it's going to be paid, the purchase amount, when it's going to be paid, closing, and any other important dates, especially when it's coming to conditions. There should always be a statement in a letter of intent that it says this is a non-binding letter of intent. It is subject to the fact that you're acting in good faith. It's a good faith document, but it is non-binding. You should always have non-binding letter of intent. Usually it's as part of the header at the very top or the very, very bottom of the letter of intent. What's the possession date? Name of brokerages and salespeople, and who's responsible? Who's responsible for lawyers or closing costs, that kind of thing. You know, on a residential form 100, it says that the seller is responsible to pay for the transfer in a deed. What happens if there's land and stuff involved in a business? Then, you know, you want to make sure that who's responsible to pay for these costs. So that's a pretty basic letter of intent. But I do see letter of intents going out that says this is that does not have number 7, that this is a non-binding letter of intent. Good faith is implied. You want to put in that it's non-binding in case something falls apart. Any questions about letters of intent? Okay. Share or asset purchase or sale. There are pluses and minuses for both types of purchases. Individual needs will vary depending on individual situations. There are sellers who will only sell one way with no negotiation, so look out. Others may negotiate the type of sale that best suits their needs. Each situation is different. I can't say which is better or worse to do, because each situation is certainly different depending on what's being sold, what are the assets, what are the chattels, what's the business looking like, what's the corporation, what's the purpose of the sale of the seller. You know, maybe they just want to get out of the corporation altogether. Maybe they want to move on. They've got other assets in that corporation. Who knows? There's so many. I can't say which one is better or worse.
Thank you so much for watching. If you like our video, please hit the like button, the subscribe, and even the little bell to get notifications, just so you can stay in touch and watch more of these great videos.